Welcome everybody today. Nice to see you all. Glad to have you here. So today we are going to talk about building foundations for financial wealth and my 12 risks in retirement. So lots of things to think about when we get close to retirement. So this seminar tonight is for pre-retirees or retirees, both of you. I think it's important to look at these 12 risks that I see, and I'll go over them again in detail. I am Kelly Slott, the owner and CEO of California Wealth Advisors. So many of you have met me through my radio show or my book. So welcome. I appreciate it. I love doing these seminars. They're so fun for me. I love educating people. I really do. I want you to understand what's available to you, what you should be looking out for. So again, that's why I do these seminars. So welcome. Appreciate you all coming. So let's get into our slides. So I'm going to go to share. I'm not so technically sound here as my staff is, so be patient with me as I move things around. Okay, so building foundations for financial wealth. Again, I do these series once every quarter, and I have a different topic I talk about, but tonight is going to be on the 12 risks in retirement. So get yourself ready, because we've got a lot of risks we're going to look at here. We want to avoid these as much as we can. So again, most of you have met me through my radio show, KNX 1070. It plays on Saturday mornings. All of my radio shows are on my website, CaliforniaWealthAdvisors.com. If you go there, you can see my most recent radio show. It's under the radio tab. If you just click on that, so you don't have to wait till Saturday morning to listen to it on KNX. You can go right to my radio show tab on my website and listen to any show you want. I think I have over 5 years of shows on there by now. So lots of shows, lots of data to be had there. Again, my book, The Great Retirement Mystery, How to Avoid the 6 Biggest Blunders. Tonight is kind of like that. 12 risks in retirement are some of the blunders that I see. So the 6 blunders I talk about in my book are slightly different. So I think that's really important. And my book is really, there's retirement in the name, but it's really for anyone aged, let's say 20 to 90. It's good for anybody along those lines, because I talk strategy in there, but also the risks that I see people make and the blunders that people make. So if you want to look at your entire financial house, I think it's very important to consider each of these segments here, because this is your entire financial house. So investment planning is the top part here. That's your investment dollars. That's your stock, bonds, and mutual funds. That's your trust account where you have stocks. That's your real estate. It's any investment you have, perhaps a business that you own. So your investment dollars are very, very important to have as part of your investment portfolio, certainly. But also you have risks involved in your entire financial house. So risk management, that is something that we do here at California Wealth Advisors. So the risk management side is, are you paying too much in taxes? If you are, that's a risk to me, because as far as I know, the government doesn't like to send you back checks when you pay your taxes or your property taxes. So risk management, as far as taxes go, I think is important. Do you have the correct insurances for yourself? Are your assets titled correctly? Could you be sued if they're not titled correctly? When to take Social Security? I'm going to talk about that a little bit tonight. That's very important. That could be a big risk in your overall financial house, because if you take it at the wrong time, you're doing a big disservice to yourself by not getting as much money as you maybe could. So that's the risk management side of your entire financial house. Let me look at your estate planning. Estate planning is very, very important. I did a webinar, 2 of them actually, last year and 1 this year, with my tax CPA and my estate planning attorney, and those are on my website, so you can go look at those. Estate planning is important. You've got to have the correct trust documents. If you don't want your beneficiaries to go through probate and have a lot of cost, please have the correct estate planning documents. Again, I work with a number of estate planning attorneys to set these up for you. You also need to have a power of attorney and a medical directive. Those are very important to have in your estate planning documents. So make sure you have that. I just had lunch with one of my doctor clients the other day, and she's a doctor, and she said, I don't have a medical directive. I said, well, what happens if something should happen to you? How is your son going to take care of you? And she said, well, I don't know. And so I said, you need to go back and update your estate planning documents. So she's in the middle of doing that. So estate planning is important. Again, how are your assets titled? Are they titled in the name of your trust? Do you have perhaps an LLC that they need to be titled in? Again, that will protect you against lawsuits. So these are very important documents to have, especially with my folks that have a lot of real estate. And then we have family offices, or vault, we call it. So your vault is where we put all of the documents from your estate planning documents, your power of attorney, your passport, your driver's license, your bank account information. Even we've had some people in our vault put their passwords and things. So it's all in one place. So if something should happen to you, your beneficiaries, your heirs will know to come to us, and they can get access to your accounts to help with your care. Or if you should pass on, they will have the trust documents to not have to go through probate and with the expenses of that. And then, of course, your investment planning is your investment dollars, as I mentioned earlier. So it doesn't matter if you have $1 million or $100 million. If you haven't taken care of all of these things, that's going to be a disservice to you and your beneficiaries as well. So I position myself in the center there as your financial director to make sure all of these things get taken care of. So very important. And I did record a private client process video that goes into more detail here than I did right now. That is also on my website. It's on the first page of my website, actually. So if you click on California Wealth Advisors, the first page there's 4 boxes. One of those boxes says private client process. Please click on that and you can find out some more information. Okay, what are the key components to investing? Well, first of all, you have to have a plan, and you have to have a plan that's designed specifically for you. We do not do portfolio A, B, or C here at California Wealth Advisors. We actually are going to design and create a plan that's specific to you based on your needs, your wants, your desires, your risk tolerance, and your time frame as well. And what do you need out of your portfolio? I ask all the time to my clients and new people, what do you need out of your portfolio? What are you looking for? How can I help you achieve that? So make sure you have a plan that's not portfolio A, B, or C. And I will say a lot of the big wirehouses just do that. They put you in portfolio A, B, or C. You will not find that here at California Wealth Advisors. We will tailor make this for you. And then of course, you need to have diversification in your portfolio. Don't have just stocks. That is great for 401ks. That is all they offer there. So that's why people bring me large 401ks often, is because they get tired of all being in the stock market. The market's going up and down and they get tired of that. So they want to have a more diversified portfolio. So the way I do it is through my master proprietary process. M is the market. A is alternative investments that don't go up and down with the market, and S is safe money backed by insurance companies. So here's a schematic of my master proprietary process. So again, M is the market, stocks, bonds, and mutual funds. It is red for a reason. It is going to go up and down. So you have to be able to handle that as part of your portfolio if that's what you have. And again, most people that come to us, they have large 401ks, $1 million, $10 million in their 401ks or their pensions. And it's all in the stock market because that's all they offer. So if you want to diversify more than that, great. We have alternatives. That could be real estate, it could be private placements, it could be gold and silver, oil and gas. Many of these programs, or all of these programs, don't go up and down with the stock market because they're not stocks. And real estate is great. Oil and gas is great. A lot of times the income we can create there is tax advantaged. So if you do those asset investments in trust accounts or outside of retirement accounts, there's a lot of tax advantages there as well. And we have write-off programs. If you sold a business, for instance, that's the alternative side too. We can do some tax write-off programs. We can do opportunity zones. We can do 1031 exchanges. A lot of different things we can do there to help you avoid and delay taxes or create tax-free income, if that's what you're looking for, tax-advantaged income. And then the safe side, S, is in my master proprietary process. That's a product that's backed by an insurance company in some way. A lot of times we look at annuities and life insurance, long-term care for the insured side of things. Because if I do a fixed or a fixed indexed annuity for you, you're going to have downside protection. It's not going to, your value will not go down. Again, it's backed by insurance companies. So I use all 3 of these sections for different reasons. You know, again, M is the market. We can have growth there. We can have income there. A is alternatives. We can have growth there and income and tax advantage income as well. And S is safe money, again, downside protection. And you can even create income for life off of those insured products as well. So again, make sure your portfolio is designed specifically for you, and it's also correctly diversified for you. Some people come to us and they only want something in the safe section. I had a client last year, he retired from a publicly traded company, and he had a lot of company stock, but he had a pension and a 401k. And he said, I don't want to be in the stock market anymore. I've been in the stock market all these years building these accounts, but now I just want income guaranteed for my life and my spouse's life. And that's all he wanted. He didn't want any more stocks, and he didn't want any alternatives either. He just wanted that insured product that will pay him that for the rest of his life. So we did that for him. But again, I like to do some money in each one of these sections because there are different benefits to each one of these. There's liquidity, there's non-liquidity, there's income, there's growth. There's lots of benefits for all of these. But again, it depends on you, depends on what you're looking for. So I will show you what's available, and then you're going to tell me what you like. So it's a collusive things that we do together, certainly. Okay, let's jump into the 12 risks of retirement. How many risk factors can you name? Well, let's look at a few here. So we've got longevity risk, certainly. We've got excess withdrawal risk from your accounts, incapacity risk, event risk, tax risk. I talked about that earlier. Market risk, certainly, with many portfolios we have. Inflation risk is huge as well. So when you have risk, that does equal a potential for loss. So we have to manage this, right? Now, things go up and down. I don't always have a crystal ball. Actually, I do have a crystal ball right behind me here. But she doesn't always tell me what's going on. So when we have risks in portfolio, it's either upside risk that we're giving up if we're doing too conservative of an investment, or we have the downside potential if we're taking risk in an investment. So again, make sure that you're comfortable with the portfolio you have and you are well diversified. So when you know the risk factors, you can develop a strategy to maximize and protect your financial assets, which is what we do here at California Wealth Advisors. So longevity risk, this is huge. I mean, we're all living longer, right? So chances are very good that you're going to live longer than you perhaps think you will. So longevity risk is really the risk of outliving your sustainable income or the income that's generated from your account. And again, I do have investments that will give you income for your life, so you don't have that longevity risk. And you know, modern medicine, we're all living longer. Our life expectancy is longer. It's expected to increase too, as a matter of fact. And here's actually a chart that shows we're just living longer. We're all going to live longer. My beloved mother is 98 years old, and she's going to Paris in May, believe it or not. So she's doing great, and we're just all living longer and doing things for longer. So you have to have your assets last as long as you live. Very important to look at that. Okay, so again, when you live longer, you've got different kinds of risk. Are you going to have sufficient income to maintain your current living standard, or maybe you're going to have medical issues and it's going to cost you more? And we don't want to have excess withdrawal from our accounts, right? So again, look at your longevity risk for you and perhaps your spouse or your loved one, your partner, and what risk do you have? Where are you on this scale? So evaluate how well you feel about minimizing longevity risk for yourself. All right, let's talk about entitlement risk. Now, what am I talking about here? Well, I'm talking really mostly about Social Security. So Social Security is a government program, certainly, and it gets income for your life. And when it comes to Social Security, it's really important and strategic to figure out when you're going to take it. So let's just throw an example on the table here. So here is Colleen, and she's 62, she's single, and she's trying to figure out when she should be taking Social Security. So she takes it at 62. She gets $1,467 a month, and she'll get that for her life, as well as she'll get cost of living increases periodically, but it doesn't really go up that much. If you've been on Social Security at all, you know it doesn't go up that much. If she waits to full retirement age, and for her it's 66 years plus 4 months, then she gets $2,000 a month. That's almost $600 more per month that she's going to get if she waits another 4 years, let's say 4 years and 4 months. If she waits to age 70, she gets $2,500, almost $2,600 per month. That again will last for her life. Now again, everybody's different with when they take it, and there are different reasons people take it. I had a client a couple of years ago. He was 60 years old when he first came to me, and he said, I can't wait to retire. I'm going to be at 62 in 2 years. I'm going to retire. I'm going to take Social Security. I'm going to be retired. I'm taking Social Security. He was just adamant that that's when he wanted to take it. And I will say he's having a little bit of challenges because he's living hand to mouth because he's not getting that much from Social Security, and his account unfortunately wasn't large, so I can't generate him a whole lot of income off of it just because the account's not large. If he'd waited a couple more years, he would have gotten more income from his Social Security, and his assets would have grown a little bit more too. So then I could create more income off of those assets. So for Colleen here, if she waits till 70, she's going to get a lot more money per month, almost $1,100 per month more than if she takes it at 62. Now you do get about 8% more per year that you wait. So 8% is a great return. So every year that you wait is good. Now remember, if you are not at full retirement age and you start taking Social Security, in this example at 62, they will be taxed more. If you are over full retirement age, you will be taxed less. So again, talk to your CPA about that. But that is something to consider, especially if you're still working. If you're still working, I would tell you, do not take Social Security. Why would you pay taxes on that? Wait and get more to 70. Now, don't wait until after 70 to take Social Security. There is no benefit to do that. I had a client, he was a new client, and he was 72 when he first came to me, and he said, yeah, I'm not taking Social Security yet. And I said, oh, no, you're over age 70. There is no benefit for you to wait until age 70. You should have started taking it at 70. So we got him on the right path. So Social Security is important as to when you take it. And again, this is different for everyone. And I go to, what is your budget? How much do you need? What standard of living do you have? Now, I will also add here, if you do not feel like you're going to live a good long life, then taking it at 62 might be okay. If you've got physical issues or something's wrong and you just don't think you're going to live past your 70s or even early 80s, then taking it at 62 might be beneficial for you. However, I just mentioned earlier, we are living good long lives these days. And my mom's 98. So where the break off there, the equalizer is early 80s, I would say. So if you feel like you're going to live past your early 80s, taking it later will benefit you. So just be aware of that. Okay, Social Security benefits, again, it's important to figure out when you do. This is actually interesting. 77% studies show of retirees expect to receive specific advice from their Social Security representative. However, Social Security representatives are prohibited from giving any advice. So don't go to Social Security and think you're going to get advice. That's not going to be how it works. Okay, let's talk about market risk. That it can include allocation risk and sequence of return risk as well. So market risk, well, we kind of know that when markets go up and down, there's risk in your portfolio, right? So you have the risk of losing your retirement assets if the market goes down and has a poor performance. Allocation risk is important too. So that's a risk of investing either too conservatively or too aggressively and not diversifying your assets. Now, remember, I talked about correctly diversifying your assets based on you. And again, I do that through my massive proprietary process. M is the market, A is alternative investments like real estate, and S is safe money like insured products. Sequence of returns risk is very important too, because it depends on when you retire and then what happens to the market after that, if you're relying on that asset that's in the market to pay you income. You might have diminishing returns there. So some of the basics we live by certainly is to buy low and sell high. Don't know we all want to do that. Of course we do. However, my crystal ball here doesn't always tell me what's going to be the right time to buy low and sell high. So what I do recommend people is to stay invested no matter what's happening with the markets, because time in the market is more important than timing the market. And that is one of the blunders in my book that I wrote about, is trying to time the market. If it's a good time to buy, it's a good time to buy. If it's a good time to sell, it's a good time to sell. So buying low and selling high is certainly the goal, but let's make sure we have good sound investments for you in the first place. So make sure you have a plan, right? I mentioned that. Don't invest and then have a plan. Actually have a plan and make the correct investments. And know what your risk level is. It's one of the first things I always ask new clients is, what is your risk tolerance? What can you handle? And then have a purpose for your investments too. What is it doing for you? Is it got growth? Is it got income? Is it got income and growth? Are you looking for tax advantages? Maybe tax-free income, maybe tax write-offs that you might be looking for. And yes, we do that as well. We're a full service advisory firm. So we do help with tax write-off programs too. And having a plan is actually knowing when to take action too. Now that's where I come in, because I am going to tell you when it's a good time to sell or buy more of something if something has gone down. Sometimes it's a good idea to buy more of that if it's gone down. Sometimes it's a good idea to sell it. We don't think it's going to perform. Okay, so that's the professional wealth management and the high-level strategies really that we bring to the table for our clients. Okay, allocation risk. I talked a little bit about this. So where are your assets allocated? How are they invested? Do you have gold and silver and precious metals? That's been big into the news lately. So maybe you like that, maybe having some precious metals. Now, historically, gold and silver and precious metals have been hedges against inflation, although I will say I haven't seen that much in the last few years. The market goes up, gold and silver goes up, inflation wasn't necessarily high in the last couple of years. And then when inflation was at 9% about 3-4 years ago, gold and silver weren't doing anything. So there's a different reason why it's up now. But also look at annuities, look at insured products. Maybe that downside protection is important to you. Certificates of deposit are great. You're not going to lose any money there, backed by FDIC insurance. However, you're not going to get a great rate of return either. And then again, I look at the real estate. A lot of times oil and gas, alternative investments as ways to diversify your portfolio and really doing something not in the stock market. So again, we want to reduce your volatility and enhance your overall financial plan. Really, that is our goal here. Okay, secrets of return. I talked about this a minute ago. So this is, I think, very edifying here because they're the inverse relationships here. So year one for portfolio A, he's down 18.39%. Whereas if you go to portfolio B on the 21st year, he's down 18.39%. Okay, so if you retire in portfolio A, you've got $100,000 and the market goes down 18+%. Your value now is $75,000. Now that means I can create less income for you off of 75,000 than I could have off of 100 because the market went down, right? So your timing was bad as far as retirement goes. Portfolio B, well, he retired and he had $100,000 and the market went up by 26%. So now he's got $117,000. That's great. Then the market went up, you can see his second year, market went up 19.61%. Now he's got $132,000. Great, I can create more income for him. Whereas the reverse is true with portfolio A. So this is why I like people to come to me 2 years, 5 years before they retire, and we start moving some of their assets from the more market-oriented types of investment into maybe more conservative investments, maybe some alternative investments, maybe some insured products. So you don't have this happen to you because nobody, again, has a crystal ball. They don't know what's going to happen with the market next year. So planning this, diversifying yourself, way important, way important. It really, I would say, was vital for you to make sure you start looking at your portfolios ahead of time so you aren't hit in the head by your portfolio going down. And again, this is what I see in 401ks. So 401ks, it's a good idea to start moving them into more conservative investments. Call us 2 to 5 years before you before you retire, so we can help you structure your portfolio a little bit better. Very important to do that. So again, portfolio A is going to run out of money in year 13, whereas portfolio B, if again, the sequence of returns is taken into account here, has got $351,000 at that point, whereas portfolio A is just wiped out. So again, we want to make sure you're correctly diversified and we're planning for this. Again, where are you with market risk? What are you comfortable with? Are you 100% in the stock market? Are you comfortable with that? And are you worried about the sequence of returns I just showed you? Or is that not a concern of yours? So everybody, again, is different with that, but I want you to think about it. I think that's important. All right, let's talk about inflation risk. This is important for all of us to think about. Okay. Gasoline in 1987, which is not that long ago, gasoline was 95 cents a share. And I didn't want to tell you what it is in California these days. A movie ticket, $3.91. A postage stamp, 22 cents. We're getting close to $1 for a postage stamp. I think that's coming probably pretty soon. And minimum wage, believe it or not, was $3.35 in 1987. So again, inflation is going to affect us. The historical rate of inflation since 1914 is 3.14%. So 3 to 4% is usually what I use as a average, if you will, inflation rate. Now, sometimes, of course, it can be higher and sometimes it can be lower. But let's just take the average of around 3%. So if we do that, what does our dollars today equal in 30 years if we have a 3+% inflation. So if we're getting $40,000 of income today, how much do we need in 30 years if inflation is 3%? Now, I mentioned we're living longer. We could have 20, 30 years, 35 years of retirement. So $40,000 today, you're going to need $101,000 plus to equal $40,000 today at a 3% inflation rate. And this poor guy is going nuts because that's a big difference, you guys. It's a big difference. You've got to have inflation hedges built into your portfolio. It's very important. The way I do that is through growth in the stock portfolio, if we're looking at that. It's also through a rent that might be coming in from real estate or oil and gas programs. They have automatic inflation hedges built in there. And same thing with the annuities. If I create income for life for you, then a lot of times we can have inflation hedges built in the payments that you get. So you need a plan. Don't just wing it here. You need a plan. And again, that's what we specialize in doing. All right, tax risk. This does affect most all of my clients. And let's ask you a question. Do you think taxes are going up? Do you think they're going down? Or do you think they're going to remain the same? So most people will say, I think taxes are going to go up. And both sides, Republicans and Democrats, both like to spend money. So taxes are probably going to go up. So it's important every year, certainly, to sit down and talk to your CPA. Bring your CPA in with your financial advisor, us, to talk about, well, what can we do to avoid and delay some taxes you might have? Now, you might be selling your business. If you're selling your business, there are a number of things we can do. We can do different kinds of trusts for you. We can do opportunity zones. We can do tax write-off programs as well. Now, you do have to be an accredited investor, and you do have to be a client of ours to work with these, to have us work with you on those types of programs. But we do have ways to help you save on taxes. So if that's you, I would say give us a call. We do a lot of 1031 exchanges as well. So if you have a 1031 exchange that you've owned for 20 or 30 years and your depreciation is gone, that income you're getting, the income from the rents is taxable income to you. It's taxed as ordinary income usually. So if we do a 1031 exchange, then a lot of times we can do a new program for you that has all of the depreciation pushed up to the first 4 or 5 years. That means all the income you get is going to be tax advantage. So that's a huge boon to people, especially when they retire. And a lot of times people don't want to manage properties anymore either. So if that's you, I would say give us a call. We can help you along those lines as well. A lot of times we say it's not about what you make, it's about what you keep. And I think that's probably important too. Keep that in mind. And taxes are a reflection of that, really, because when you write a check to the IRS, they're not going to send it back to you. So knowing in advance the taxes you're going to have to pay when you get into retirement, again, are you selling a business or are you just taking money out of retirement accounts and living off of that? It's important to know. The other thing you need to remember, and I think a lot of people forget this, when people bring me 401ks, they bring me pensions and we create income for them, that's taxed as ordinary income. Unless it's a Roth, that's a different ball of wax. But if it's a regular 401k or a regular pension, even an IRA, 403b, 457, all those types of accounts, once we create income for you and we start taking money out of those accounts, it's taxable as ordinary income. So be aware of this. A lot of people forget that there's taxes to be paid on retirement distributions. So where are you in your risk tolerance there? Where are you in your comfort level here? Again, I just want you to think about it. All right, let's look at healthcare risk. Healthcare is a huge factor for most all people I talk to. Their medical expenses, incapacity, event risk, something that might happen, maybe a heart attack or something, cancer might hit you, you just never know, is scary, certainly. So how are you going to take care of it? And you know what? The different kind of risk levels, the different kinds of diversification and planning we do is a lot of times based on your go-go years, your slow-go years, and your no-go years, especially when you get into retirement, because those are the 3 phases of retirement. So your go-go years, that's maybe right when you retire. Maybe you want to travel a lot, and that might cost you more. So again, what's your budget? Did you budget in travel? Maybe you're doing expensive travel. Maybe you're not doing expensive travel. But put that in your budget. And I do have a budget sheet on my website. So go there, CaliforniaWealthAdvisors.com, and print out that budget sheet for yourself and figure out what your budget is going to be in retirement. Maybe do a budget sheet for now when you're working, and then do another budget sheet for what you think you might be spending in retirement. It's really edifying when people do that. So those are the go-go years. Your slow-go years, and maybe when you're a little older, you're not traveling as much. And then your no-go years, of course, maybe where you're just spending most of your time with your grandkids, which is great. So plan on this. All right, so healthcare risk. So medical expense risk, the risk of paying for the growing cost of health-related services in retirement. Incapacity risk, maybe you can't do anything. Maybe you've got deteriorating health, and that's a problem. And then, of course, event risk when you have either a family circumstance or maybe you have a heart attack or get cancer or something. So the cost of skilled nursing is very expensive. So look at the difference here. In 2007, it was, from semi-private to private nursing home, $50,000 to $65,000, $58,000 to $65,000. 2016, which is, yes, a number of years ago, so it's even more now, is between $82,000 to $92,000 a year. Very expensive to have private nursing or semi-private nursing that you might need. So how are you handling this? Well, what are you doing to alleviate some of the costs here? And again, this just shows the nursing care costs are going up. Now, the way we look at things is, how do you want to live? Do you want to live independently at your home, or do you want to be in a residence of some kind, assisted living residence of some kind? And again, there's different costs to each one of these. And maybe you don't want to move in with your family. And so maybe you don't want to spend down the assets you have because you want to leave some assets to your beneficiaries. So the way to do that is, well, what do you have with long-term care? Do you have a policy? And so I used to put people into straight long-term care policies, but they're really cost prohibitive these days, I will say. They are $30,000, $40,000 a year. And if you died the next day, you get nothing. That I don't like. That's not a good investment in my opinion. So the way to get long-term care to help pay for it is through a number of different ways, really. One is looking at old life insurance policies or old annuity policies. If you have these old policies and there's no long-term care attached, I can do what's called a 1035 exchange into a new policy and add long-term care. That's very beneficial for people. So again, a lot of times people come to me because they have old life insurance policies or they have old annuities and they're not performing very well. There's cash value there, but they're just not performing. And they don't have long-term care. So a lot of times I can move them into a better annuity or a better life insurance policy that has long-term care now and has some growth potential to it. And again, that can be a benefit for your heirs as well. What if you woke up tomorrow morning and you're unable to perform the routine activities of daily living? How would you pay for your care? Would it be your personal savings? Would you ask your family members to take care of you? Are you going to go into Medicaid? And I hope that doesn't happen to anyone because it's not fun. It's not a good program. Do you have long-term care insurance? How would you handle, or who would handle your finances? Now, again, I talked about estate planning documents earlier in the seminar here. And so having the correct estate planning documents, the power of attorney, the medical directives. So again, who would handle your finances? Who would handle your medical issues that you might have, your family, your friends? Again, having those powers of attorney, very important. So think about this. So where are you on your healthcare risk? What are you worried about here? If you're worried about it, you should do something about it. All right. What unexpected life events could derail your retirement goals and your plans? And it can be different for anybody, but maybe you're going to lose your job. If you lost your job today, what would you do? Maybe you got in a car accident and you got sued. What would you do? What if you become disabled? What if you all of a sudden have prescription drug costs that are now very expensive? What would you do? Again, not always fun to think about some of these things, but I want you to. Are you addressing it? Are you talking to your loved ones? Do you have the correct documents? Just imperative, really, that you do this. So what's the takeaway? That resilience is about being able to overcome the unexpected. Be prepared. You may not be able to predict unforeseen events, certainly, but you can be ready financially to handle it, or at least have your loved ones know how you want it to be handled. So again, are you ready for what lies ahead for you? Because this is true for all of us. All these things are going to affect us in one way or another. So again, tax risk, inflation, lifestyles, when you're going to take Social Security, your asset allocation, is that correct for you? Medical expenses, incapacity, all these things are very important to think of and address, and please address them. And we will help you with that if you haven't already. Now, again, we are a fiduciary. We always have been, always will be, which means we put your needs before anyone else's. Absolutely. We are always going to take care of you in that way. We are very proud of that. And we are very proud also of our A+ rating on the Better Business Bureau. So we're a little feather in our cap there. Now, just like this event tonight, we do have many events that we do. Please go to my website, californiawealthadvisors.com. You can sign up for our future events. We have, as I say, many building foundations for financial wealth events. We have in-person events. We have product-specific events as well periodically. So check the website for the next one that might come up. Now, if you're new to me, call the 800 number and get yourself on our calendar. I like that first meeting to be in person. That is my preferred way. I want to shake your hand. I want to get to know you. I want to make sure that I can bring to the table what you might be looking for. I can do Zoom meetings and phone calls as well, but I do want to get to know you. And I don't take on everyone as a client because I want to make sure I can actually bring to the table what you're looking for. So if you want to trade futures or options, I don't do that. I'm a much more conservative advisor than that. I'm going to do 2-year, 5-year, 10-year investments for you and really have a plan that's designed for you. So again, I am Kelly Slott. Thank you very much for attending tonight. Oh, we do have some questions. Let me grab some of those. If you put some questions in the chat tonight and I don't get to them, it's because maybe I thought I answered it, or I will get back to you the next day and taking care of that. But let me look at some of the questions we have here. Okay, so my current advisor doesn't do any of the things you discussed. Will you help me? My current advisor doesn't do any of the things you discussed. Will you help me? Well, that's unfortunate. Your advisor doesn't really help you too much. That's too bad. I have a lot of people that actually tell me that. They sit down with me and they say, my advisor has never told me about alternative investments. They've never told me about tax savings I might be able to do, or they've never told me about insured products with downside protection. That's too bad because we do that. We're a full service advisory firm. So yes, I can help you. Again, I want to sit down with you. I want to ask you a lot of questions. What's your budget? What's your income? What assets do you have? And how can I make these assets more beneficial to you? What are you looking for? Are you looking for more income? Are you looking for tax advantages? You want to maybe create as much assets as you can to leave your beneficiaries. So again, everybody's different with that, but get yourself on our calendar and we'll take it from there. Okay, another question. If I had $1 million in my IRA, what income could I create? Oh, that's a great question. A lot of people come to me and they say, I don't know if I can retire, or I want to retire, or I don't think I can retire for 5 or 10 years. So when I look at the budget, which again, I always ask people, what's your budget? What are you spending each month? And I look at the assets they have, and maybe they have rental properties, maybe they're taking Social Security, maybe they're not taking it yet. And I look at it and I say, okay, I can create X dollars for you. And if that X dollars is bigger than the Y dollar budget that you have, hallelujah, yes, you can retire. So just to give you an example, if you have $1 million, I can generally get around 6% pretty easily these days without taking too much risk in a number of different vehicles, certainly. But let's just say we can get you 6%. So 6% times $1 million is $60,000. Okay, if that's in your IRA, that's $60,000 we can create and send to you. But don't forget that $60,000 is taxed as ordinary income. So you've got to factor that in as well. Now, if you tell me I need $60,000 out of my $1 million account and I create it for you, that's fantastic. If you say I need $80,000 or $100,000 out of my $1 million account, well, that's 8%, that's 10% I have to create for you. That's taking a little bit more risk, isn't it? So it just depends on you. It depends on what you want out of the account and what your budget is. So it was one of the first things I always ask is what's your budget? So you could have $1 million, you could have $10 million. It just depends on what do you need out of the account each month to satisfy the living that you want to do, right? And those go-go years, as I mentioned. Okay, the last question I'll do in the interest of time here. Can I retire? Oh, I love this question too. Okay. Again, I have a lot of clients that come to me and they say, I want to retire. Can I retire? Well, again, I look at, well, what's your budget? What assets do you have? What kind of income can I create off of the budget that you have? What kind of risk do you have? What kind of time frame are you looking at? These are all the things we consider when we create a portfolio for you. So if you say, I want to retire, or can I retire, or when can I retire? Again, that's why we sit down with people, is to go over, okay, this is what you have. This is what I can create. Is it enough for you? Or you need to work a few more years and save some more dollars into these accounts? Or these are the dollars I can create for you. This is the budget. The dollars I can create are way more than what you're saying your budget is. That's great. You can retire tomorrow. I love being able to tell people that. And really, when I bring that smile to people's faces, it's so rewarding, I have to say. That is why I do this business. I really would do it for free if I could. So if that's you and you want me to sit down with you and you're either selling a business, you want to retire, or you don't know if you can, maybe you have a portfolio that's not performing like you want it to, maybe you need more taxes deducted, tax deductions, maybe you need tax-free income, whatever it is that you need, we can look at ways to create that for you. So I would say, get yourself on our calendar. We'd love to sit down and chat with you. Go to my website, get my book here, listen to my radio show. I encourage you all to do that. So again, thank you so much for coming tonight. We really appreciate it. Again, if I didn't answer your question, by all means, let's get back together tomorrow and we'll get that taken care of. And if you have any other questions, you give us a call. Okay, thanks you guys. My pleasure. Take care.